Hi traders, this is Dr. Barry Burns with TopDogTrading.com. Thought I'd go a little different route here today with this free video. We've talked about moving averages, we've talked about some indicators and so forth, but another tool, or I should really say toolbox that I use, is market geometry. And market geometry is, as I just indicated, really kind of a little portfolio of tools. And some of the most common would be, for example, Fibonacci ratios, Fibonacci retracements, things like that. You're looking at the market moving in ratios and in certain consistent percentages. So, for example, again, just the most basic thing that pretty much everybody knows would be a Fibonacci retracement. Here we go. Okay, so if we took from this high to this low, for example, starting with this high, measuring to that low, notice that in this particular case I'm using the real bodies of the candlestick, so I didn't come all the way down to here. You can do it either way. I know some people who do it from extremes, and others use the real bodies of the candlesticks. The way I look at it is, yes, I could go down to here, but does this value really matter? A lot of times I talk about what's meaningful in the market. Okay, so what I mean by that, it depends on the context, but in this particular case, is this price zone here, the fact that the market moved down here to this low, is that meaningful? The answer would be no. Because for those familiar with market profile, this is actually a rejection of value down here in this area. The market did come down here and then pulled all the way back up and closed up here. So it tested this zone, if you will, this price zone, but it did not find value there. It said, no, the market is worth more than this. And when I say the market said it, that means all the participants in this great auction called the stock market. This is the S&P daily chart, by the way. And so therefore they said, no, this price down here, the market's worth more than that, so this test is not producing meaningful price action other than to say it did not find value down here. In that way, it has some meaning. But it's saying that the real solid low is right in here. And this area of price is rejected. So that's why I drew it from there to there. Now, as you can see, okay, so we've got our Fibonacci ratios here, 23, 38, 50, 62. I don't actually use the actual Fibonacci ratio up here, and it works pretty well. The 50% is the most significant, and sure enough, the market comes boom right to it, right to that purple line. Comes back down to the 23, comes back up again, retests the 23 here. Okay, comes back up and it finds some very, very significant support right here. Gets above this as the 100% level, gets a little bit above that, but again rejects this higher price zone. It says no, that would be too much. The market is not worth that much. So rejects these higher prices and comes right back on down. Okay, so that's the one that everybody knows. That's baby stuff. So let's take this off of here. Let's take this off of here, and let's. Oh, I'm putting new ones on every time. That's what's going on. There we go. Okay. Now, what we got is a GAN fan. And actually, we're not even going to do a GAN fan, we're going to do a GAN box. So we come on up over here, look for this high, draw it back down into here, and boom. Okay, now I don't have time to explain all of this because these videos have to be pretty short, but here's the bottom line of how this works. So again, I'm using the same 2 points of reference, significant high, significant low, and you'll see again we have some nice horizontal lines here, and those are basically the same ratio. See, there's our 50% right there that it comes to. But now we have two other types of lines. Number one, we have vertical lines. This measures time zones, not just price support resistance. It actually creates time support resistance. And then we also get angles. So you see the market did respond to this angle right here and in through here as well. But let's just talk about time today. This red line is the 50%. Remember I said 50% was the most significant, 50 and 100. So that's 50%, that's 100, and there, that red line there again is 50. And if you notice, of course 50, now this is where we marked it, so we can't really say, oh, look how significant that is. We moved the 50% line to that, so that's just because we put it there, we plotted it there. But then the 100% line would get a lot of energy coming back into the market. Big, big, big green bar there. If you can see that big, huge green bar. We come back up, and then here's the next 50% line. And again, this just happened. Boom! Big, big, big move down right on that 50% line. Now again, people get a little confused on this sometimes if they haven't seen Fibonacci time zones before, but they're used to horizontal price lines, but you can do the same thing with vertical price. See, your chart has two axes, X and Y. It has price along the bottom and time along the bottom and price along the side. So why use Fibonacci ratios for only one of the two axes? Use it for both. And traders have been doing this stuff for years, and it's very, very powerful. So a little extra tool, check your software, see if you have any of these tools, Fibonacci time extension tools, or time retracement tools, or Gann fans, or Gann boxes. Some of the more rudimentary charting software programs do not have these excellent tools. The more advanced ones do.